At Capella University, you can learn at your own pace with our FlexPath learning format. Take 1 or 2 courses at a time and complete as many as you can in a 12-week billing session. With FlexPath, you can even finish the bachelor's degree you started in 22 months for $20,000. A different future is closer than you think with Capella University. Learn more at capella.edu. Fastest 25% of students. Cost varies by pace, transfer credits, and other factors. Fees apply.
Reality radio for a really great future. We're talking real money.
One of the biggest reasons why all of these podcasts and all of these get-rich-quick schemes and people like Rich Dad, Poor Dad, Kiyosaki dude, one of the reasons that they all flog this one way of getting rich in real estate is because of the power of a thing called leverage, a crazy little thing called leverage. It's because particularly in real estate, leverage is used heavily in real estate. It is not used as heavily in other forms of investing. But in real estate, people often buy with, no money down or low money down, or, then when you buy a house, maybe you have to put 20% down to get no PMI, but you still don't have much in the property. You've got 80% that's borrowed. So it does, when prices are rising, leverage enhances yields, but leverage has a dark side. Welcome to Talking Real Money. I'm Don McDonald. That's Tom Cock. And I'll let you decide which one of us is the dark side of Talking Real Money. We know, but we're not going to tell you.
Exactly. I'm coming in pretty dark here, though, because listen to some of these numbers. It's astounding. First of all, there are billions of dollars every day pouring into leveraged funds. Wacky.
Now, we're not talking about real estate anymore. We're going now to investment vehicles.
Yeah, we're like single stock leverage funds. Really weird stuff like that's just pure gambling. You can't call that investing, but
we call it investing when it's real estate.
Yeah, I guess so. You're right. But if you bought the leading exchange trade fund investing in long-term U.S. Treasury bonds from its peak in August 2020, I haven't shared this number with you, you'd have lost 41% by now. That's no leverage.
In treasuries. That just shows you the volatility of long-term bonds.
Another reason we would suggest you keep your maturities short. But let's just talk about that concept with a little juice. The Direction Daily 20-plus year Treasury Bull 3X.
3X. Ooh.
So this is 300 times the up.
What's the symbol of that little baby?
I don't have the symbol. My bad.
I'll find it.
Direction Daily 20-plus year Treasury Bull 3X shares.
20. Okay, I'm going to look it up.
Which triple the daily return of a long-term Treasury bond index in that same period of time. Guess what? You lost 90% of your money. 90%. I mean, this doesn't sound like Treasuries, but it's a mirror image. The Direction Daily 20-plus year Treasury Bear 3X. You're making
so you're borrowing money
Yep.
to bet against Treasury prices rising.
Exactly.
Okay. So
Three
in a
times.
scenario where you're betting, where you didn't do well on the bull side, you must have done well on the bear side.
You didn't do well. You did really well. Very well. The opposite of the 3X bull, the 3X bear, gained 266.6%.
Wow.
And there's not often when we tell you you're going to make more on that side of the equation. So
wait a minute. On the bull side, because you were betting on long-term bonds rising and they fell.
Yep. Which probably would have been the play you said in 2020. You would have thought,
you pretty much lost all of your money. I mean, you were
90%. Yeah.
Yeah. I mean, I'm looking at it. 2021 down 20%. 2022 down 73%. 2023 down 13%. 2024 down 36%.
Don't take long. You're getting pretty small numbers there. So, yeah. Okay. So Jason Zweig says these funds should be, instead of exchange traded funds, be called extra touchy funds. Leverage and inverse. At the end of February, according to Morningstar, 316 leveraged or inverse ETFs held a total of $115 billion in assets. That's up from 183 funds with $54 billion at the end of 2020. So in 5 years, those have more than doubled both the number and the amount. And these are funds that are trying to either, 2 times leverage, 3 times of the daily return, turning 1% market rise into a 2 or 3% gains. Oh, that's right. And as you mentioned, Don, they can magnify losses.
Okay, now
the other direction.
I want to come back though to longer term performance with these two vehicles, because I think that's very telling also. And the 15-year average annual return for the 20-year Treasury 3X Bear fund.
Yep.
Bear fund. Yep. 15-year average annual return. Negative 20% per year.
Which is weird considering what it's done the last 5. So,
right.
Yeah.
But over the 15 period, which is what we believe, if you're going to look at performance, look as far out as you can.
Yep.
The 15-year average annual return was hugely
this
negative.
This is the bull now. Oh no,
that's
the
bear.
Yeah, the bear. Yep.
This is the bear. Now on the bull side, get this. You didn't win in either case. Let's say you had both of these funds and you thought, if I have both, I'm certainly going to do okay over a long period of time, right? I've got upside and I got downside. If you had the 20-year Treasury 3X bull fund from Direction, your 15-year average annual return would have been negative 2%.
But you did better than the bear. I feel good about yourself.
But the fact is, both of them would have lost you money.
And what about just a long-term U.S. Treasury fund in that 15-year period, which you could own at Vanguard? I forget the ticker, but people have written us about that because they're like, we've lost money for 5 years. Yeah, because the maturities that have been out that long have really gotten beaten up.
I need the mutual fund because I don't think the ETF.
They probably won't go back the full 15 years.
Let me see if we have 15 years on the ETF. We do. Vanguard Long-Term Treasury ETF. Here's the difference. Let's say you just bought it, and it was a terrible investment, by the way. Still down 30% in 2022.
Wow, yeah.
Terrible.
Because of the length of those securities.
Right. But that would have had a positive 3% annual return, according to Morningstar.
Average annual return over
3%.
15 years
15
plus
years.
3.
3. Which
is not that far from the historical norm. I mean, you'd expect them maybe 5, something like that.
Yeah, I would expect maybe 5. And here's one of the bigger rubs, too, with all of these leveraged and inverse products. The expense ratios are gigantic.
How much?
On the directions, it's just under 1% each.
Good Lord.
So
you're paying a lot.
That's a lot.
Yeah. They're higher, certainly, than
leverage
most.
Is just in investing. Leverage is just a way to make it more risky because that's the other thing I forgot. Let's see. Hold on. Let me go back to the Vanguard Long-Term Treasury. I want to pull up its 10-year standard deviation, which measures volatility. Something that whose value changes not at all, doesn't move at all, has a 0 standard deviation. The Vanguard Long-Term Treasury 10-year standard deviation, 13, which is pretty low.
Yeah.
Lower than stocks, but not as low as shorter duration bonds. However, let's look at the 20X Treasury Daily Bull, which is the least volatile of the two. And it's...
You said 20X, you meant 3X, but 20 years.
The 20-year 3X.
Yep.
Okay, remember, standard deviation of 0 is not at all.
Yeah.
The
flat.
Treasury, which is a high standard deviation, is about 10. Did I say 10 or 13?
13.
Sorry, 13.
Stocks we'd expect somewhere in the mid-teens.
16, like 16, 17. The daily 20-plus year Treasury Bull 3X ETF, 41% standard deviation.
Which should tell you everything you need to know.
41%.
Okay, so coming back to people that use these funds. And somebody, one expert said, if you get a whipsaw market, you could find a lot of your profits eaten away, your losses amplified because of the pattern of return. You have to have the direction right, and you have to get the path of travel right. The timing has to be impeccable.
We don't even think you can pick the right stock consistently.
Exactly.
So how are you going to pull all this other stuff off?
But I think these funds are a bad idea if you're an investor. These are not investments. These are speculation. I think these are bad investments if you don't really understand and accept leverage for what it is. And then the other part, Don, is that we know, because we talked to so many of you, this is a really bad idea if you have limited risk tolerance, because you really got to watch the ups and downs on a daily basis. But if you had to, if you really wanted to be in these exchange traded funds, extra touchy funds, you got to be a trader. You got to get up every morning. You got to move the money here or there, depending on whatever's going on. You got to accept that you're at times going to lose a lot of money. You got to have a very high risk tolerance. You need to understand leverage. And at the end of the day, people using these have to know they are speculators, not investors. This is not a long-term way to wealth. This might be a daily method to move in and out of markets. And I think the folks at Direction would admit that, probably.
Oh, I would hope so. They have to know that.
Yeah,
they have to know that. But I want to go back to that standard deviation number to put everything in perspective for you. Let's start at the very top of the heap. The Direction 3X 20-year plus Treasury Bull, 46% standard deviation.
That's off the charts.
Okay, here's your perspective. VT, the Vanguard Total World Stock Index.
Don't tell me. 17.
Which is a pretty risky, 16.61, 17 if you round it up.
Pretty close. Yeah.
The Vanguard.
That's all stocks. This is treasuries.
The Vanguard Long-Term Treasury ETF, 13% standard deviation.
Makes sense. Yeah.
The Vanguard Total Bond Index, BND. Go ahead, guess.
Wow.
15.
15, I'll say like 7 or 8. I always forget how much. 5. Okay.
5.
Yeah.
There is the story of risk. That is the story of risk in a nutshell.
You need to know.
Yeah.
Even if you're not going to use these products, you need to know that about any dollar you invest.
It tells you a lot.
It does.
It just tells you a lot
more than
about
the returns in many ways.
It tells you how scary it's going to be. And really, when it comes right down to diversified portfolios of any kind, it's a matter of scare factor rather than permanent risk. It's more about how frightened you're going to be because of the volatility.
Yeah. And especially for those moving into or in retirement, I counsel less. Because you're going to be pulling the money out. You're going to be watching it more in many cases because you're sitting.
You're retired and sitting in the backyard gardening.
I was just going to put you with the lemonade, but okay, if you really want to get on your hands and knees and start pulling weeds,
can I have whiskey in my lemonade?
A lot to do the gardening, please. So extra touchy funds, yeah, you bet. These are really touchy feely.
Mm-hmm.
Don't touch them with a you know what. So yeah.
You have written questions that came in at talkingrealmoney.com on the Contact Us button? Dang.
Keep sending them. Keep writing, people. Write them down. Or
speak them.
If Don,
I'm getting low. I'm down to 3 for next week.
Oh, no. Okay. So call. It's easy to do. You just hit a little button, right? I've never done it. I guess I could do it.
Go try it. It looks like a microphone.
And then you just start speaking, right? And people sound good.
Yeah,
it's really nice. I really appreciate that. So
plus, I can apply a little noise reduction, do a little tweaking in the mix and post-production, make you sound so good.
Yeah, I love it. All right. Yeah. This comes from DM in beautiful
Don McDonald.
M.I. Washington. I think that's Mercer Island, but he didn't give us the address. So I know who this is, by the way.
Oh, you do?
I do, because he's written us before. Question.
Is this Paul's brother, Dave Merriman? Or?
Dave Merriman. He does have a brother. His name's not Dave. All right. How to determine... I ran into him randomly. Did you know this? At Lake Chelan one time when I was buying gas.
Dave Merriman?
No, his brother.
Oh, his brother.
I was buying gas, and he worked at the place selling gas. It was fun. Nice guy. I think he lives in Mexico now. All right. At any rate, Paul's going to now write me and correct me. Question. How to determine the net value of direct investing after fees, taxes, commissions compared to the S&P 500 index. I think what he's talking about is
direct indexing.
Direct indexing is my take.
I think he's probably talking about direct indexing.
Yeah, which is buying specific stocks. It's harvesting losses. Sometimes it's used to get out of a big position of some kind. And the answer, DM, is...
I don't know.
Exactly. Nobody knows because every circumstance
is different.
Exactly.
And the reality is, here's the thing. Generally, you're going to have to pay more for direct indexing because it is personalized.
Although it's pretty cheap these days.
Yeah, but when you buy the Vanguard Total World
it's going to be more expensive than that. No question.
At 3 basis points or whatever it. What is VT now? VT is
is it 3?
6 basis points. Okay. 6 basis points.
Make
6
them a little
100ths of 1%. You are never going to find a personal advisor who is going to manage a direct index portfolio for 6 100ths of 1%.
Okay, but DM is missing the point here. The point of direct indexing should be around taxation, not around returns.
Right.
That's what it should be looked at. But many people think, I'm going to get rich because they're going to put me in the right 50 stocks.
No, because it's direct indexing.
No, exactly. Think that through. What we're really trying to give you is a representative of the market and then be able to buy and sell those things to allow you to tax loss harvest. And boy, could you imagine this quarter with some of the tax loss harvesting you got to do with Tesla and NVIDIA and
rapid fire tax loss harvesting? Yeah,
man, would have been great stuff.
And actually, the answer to the question, if he doesn't mean direct indexing, if he means building a portfolio based on whims and wants,
but direct investing maybe is, instead of just buying the S&P 500, building your own index.
Or building your own portfolio that you think is good.
Right,
Then my guess is you're going to underperform the index because you have to. It's always because professionals underperform in aggregate, underperform dramatically just buying the index.
Plus,
so depends on what you meant.
Think of the work. Even if you just said I'm only going to own 100 stocks. Now you could buy the stocks for nothing, right?
I am net worth wise, technically, for the first time in my life recently, a millionaire. Okay.
Really?
That doesn't say anything. Oh, you are too.
Oh, okay.
Yeah. But not by a lot. We don't have enough money to direct index.
No, we don't.
We don't.
So, yeah.
I mean, if we were Muscovites, we would have enough.
Exactly.
Not living in Moscow, but being like Musk.
Hello. Yeah, got it. In today's world, nobody knows what a Muscovite is other than a Muscovite. That they might know. All right. Another question. Save us. Ryan from Jackson, Tennessee writes, my wife has left her employer. She had been contributing to a Roth 401k. The administrator has higher fees than preferred. I plan to move the money to a Roth IRA. Mm-hmm. When doing a trustee-to-trustee transfer from Roth 401k to Roth Roth IRA, will the dollars from my wife's employer contribution be taxed?
No. Not at all. No, not at all. They're just going to roll right over. Just roll right in. Just slide right in. Actually, it's a transfer. Not to do that. Actually, it's a transfer. A rollover is technically when you take the cash
and you have 60 days to put it back in.
And then you have 60 days to roll it over. Direct transfer. It's a direct transfer, and there's no the contribution of your employer is tax free.
Yeah, there's I could see no reason not to do this.
No, me neither.
Sometimes there would be a reason not to move money from an employer plan to an IRA, because now you got money in an IRA that eliminates the opportunity or makes it a more taxable proposition if you decide to do a backdoor.
Yeah, and the other thing, there is one other argument, and I hate to make it because I think it's so.
I can see it pains you, but go
ahead. It
ahead.
pains me to make it.
Yeah.
401ks have greater protection from creditors.
Good point.
I
don't think
IRAs.
in this state, but I think others maybe, because that's a state-by-state thing. Yeah. So you're right. You're going to get ERISA protection that you would not get in an IRA. Fair enough. But in this case, Ryan, make the transfer, build the portfolio, get on with your life, and I hope your wife gets a new job if that's her goal.
Maybe she wanted to leave.
Yeah. I don't think my wife's angling for a new job anytime soon. So.
All right. What are you doing?
waiting for you. That's it. That's all
I was just
got.
sitting here waiting for you to finish up. I didn't know if you had another question.
I have no more questions. I could have had more because I have them. But
you're the question master here.
Well, that's it for today's question.
You're in charge of all the questions.
Sorry, I wasn't very descriptive there. So
I don't know what you were talking about.
Yeah, so that's all. Please send in your questions, either spoken or written, to talkingrealmoney.com. Easy to do either.
All righty. Sounds like a plan.
Yep.
Thanks so much. Thank you all for being there. And remember, we're here pretty much all the time talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.